Hi, thank you for checking out Keystone TV. The fact that you're watching this video shows that you care about your financial well-being and your investment future. I want to talk to you today about something that I've just been hearing a lot from investors, and I see in the news, and I'm sure you have as well out in the media, right? The market being at all-time highs. There's just been so much talk, and with that has come a lot of speculation from investors, a lot of fear. Is now probably not the right time to be in? It's at an all-time high. Maybe I should back off my stock exposure because we're at an all-time high. And so I thought I'd do a little digging, a little research on this to determine, really the history behind all quote-unquote all-time highs. And if there's any real truth or validity to why it would be prudent to get out when we were at an all-time high. Obviously, none of us actually know what's going to happen next. We have to. That's a topic for another video. But assuming that none of us believe we know when the market's going to go up or down, I thought we'd just look at some data. So I took data from 1926 through 2009. Okay, so I took over 80 years of data, and one of the things that I looked at was periods of time and how often we were in all-time highs, as well as how the market responds following all-time highs. Here's one of the most interesting first things that you need to look at. Of the last roughly 1,000 months, we were at an all-time high just over 28% of the time. Meaning being at an all-time high is not some abnormal, highly uncommon event that happens, once every 20 years. 28% of the time, the market's at an all-time high. 28% of months of the last 1,000 months, the market's at an all-time high. So the first thing you need to understand is that that's not some this is some highly unusual thing. Now, what I looked at was, let's look at 5-year periods of time following months that were at an all-time high. And over the last roughly 90 years, those have returned just over 9% per year. So of the 5 years following a month where it's at an all-time high, you've made roughly a little over 9% a year. Over the other 72% of the months that were not at all-time highs, the market averaged just over 10% a year. It was less than a 1% difference per year annualized over 5-year stretches following months of all-time highs and months that were not all-time highs. Now, if we look at 10-year stretches, it's no different. Little over 9%, 10-year stretches following months that are all-time highs, and just over 10% in 10-year stretches on months that were not all-time highs. So I just want to remind investors to stay the course, to build a prudent portfolio that's globally diversified, right? Follow the 3 rules of investing, buy stocks, okay? Diversify them and rebalance. Don't try to time the market. Don't try to pick the right stocks and start stock picking. Don't start track record investing and trying to figure out what's going to be the best thing based on how it was last year. All right? And don't let all the all-time high talk scare you. Rebalance your portfolio, stay disciplined. Hopefully you're working with someone that helps you understand these concepts so that you can have a phenomenal investment experience and accomplish all the goals that you should accomplish, that you have to accomplish in retirement or with college funding or whatever it may be that you're passionate about and that you're trying to achieve. So I hope that this was helpful, putting this all-time high talk in a little bit of perspective. And if you thought this was helpful, check out the rest of our videos. They're archived at KeystoneWealthPartners.com. Or you can like us on Facebook and get content there at Keystone Law Firm and Wealth Partners. Hope you have a great day, and thank you again for watching our video.